Sole trader versus limited company. Which is better for a UK entrepreneur? In this video, we're going to break down the pros, the cons, the understanding of what each actually is, what difference that makes to you as a business owner, the tax advantages of being sole trader or being a limited company, and a clear understanding of which is right for you. I'm Josh Thomas, the founder of Thomas & Co International, one of the UK's leading tax advisory firms, helping hundreds of entrepreneurs save millions in taxes every single year. We have a team of high-level strategic advisors that have had insight into thousands of businesses that allows us to then help entrepreneurs build profitable, scalable, and tax-efficient businesses that create long-lasting value, increasing enterprise value, all the way up to the position where they can then choose whether they want to exit and create generational wealth. All of this knowledge that we've amassed through all of this experience gives me everything that I need in order to arm you with all the knowledge and information you need as a business owner to make the right decisions, to be tax efficient, and take off some of that pressure that HMRC are putting on business owners across the UK. So we're now going to break down the pros and cons of a sole trader before moving on to the pros and cons of a limited company, as well as making sure towards the end of the video, I give you a real life case study and a side-by-side example on what you will pay as a sole trader with X amount of profit and what you will pay as a limited company with X amount of profit, so you can apply that to your real world scenario. As a sole trader, you have full personal responsibility for all income, expenditure, assets, creditors, liabilities. That income is yours as personal income once it's earned. A sole trader, for example, would be painter and decorator, a plumber, someone who's in construction locally as a subcontractor. But it can be any business. If you're a small contractor, a consultant, or you're even starting out a product-based business, everyone can start as you being the business, not having this separate company that's set up officially on Companies House. It's not always absolutely necessary. And that comes with pros and it also comes with cons. And I'm going to break them down for you now. So the pros for a sole trader. One, it's easy to set up. All you need to do is register with HMRC under what's called self-assessment. You'll get a unique tax reference number, and then you need to submit a tax return once per year. There's no additional complexity to that. So it's nice and easy for people just starting out in business who don't want that admin and operational headache of a full limited company. So complexity is definitely something that's reduced. And with that simplicity and just the one submission to HMRC per year, that means you as a business owner are going to pay a lot less in accountancy fees. Because you don't have to go and set up a separate corporate entity, that also means that you've got additional privacy. You're not listed on Companies House on an official company register. So your details are private to the public. It also gives you direct control. You are responsible for everything, which gives you direct control as the business owner to how you portray yourself online, what is shown and what is not, which gives you some flexibility on privacy and what you actually put forward to potential customers, suppliers, etc. And for business owners that aren't necessarily earning extremely high amounts of profit as of yet, it can be a lot more tax efficient. So for the cons, you do have unlimited liability. You are now responsible, as mentioned in the pros, for everything, all of the income, all the expenditure, and all the creditors. So if you do always supplier money, and that supplier has the right to then come and pursue that debt off you, you are personally responsible, meaning your personal assets are also a potential for that creditor to pursue. So your home, your car, your assets are all at risk because you do have unlimited liability. When working with larger clients, you also want that credibility that a limited company does bring. Whereas with a sole trader, you don't have a separate entity. The supplier or the customer that you're working with can't go and review Companies House and see your last accounts. Because you have that privacy, it also then means that other people can't stamp that validation on you as a business owner. It also comes with limited planning that's available. Because you earn the income, you pay your expenses out, and then you tax at the end of the year in line with HMRC's tax years, which is 6th of April to the 5th of April every year. There's no real flexibility for retaining profits and making sure that you defer certain payments as there is with a limited company, which we'll get into later. Then when we get to the tax inefficiency, as your profits start to grow as a business owner, you're going to have income tax at 20% up to the top of your basic rate band. You're going to have then 40% when you go into higher rate. You're also going to have national insurance at 6% in basic rate band and 2% outside of basic rate band. So as then profits start to increase, your effective tax rate starts to increase rapidly. You also have a massive amount of limitation if you want to exit the business. If you've created an asset, you've got goodwill, you've got brand assets, you've got a customer base, you've got a track record of consistent, strong financials, and you want to sell to someone, whether that be a competitor or someone just looking to acquire in your space, it does bring limitation because you don't have official company accounts, consolidated financials. So it does bring limitation when you want to exit. So, limited company. It's going to be a separate legal entity from yourself as the individual. It's going to be set up on what's called Companies House, which is the official company register in the UK, meaning that the separate legal entity pays corporation tax, not you as the individual. And if you then want to extract funds out of that separate corporate entity, you then choose to do so via what's called the dividend, which is a distribution of profits, or you take a salary from the business. So it gives you additional flexibility of retaining income, retaining profits within a corporate entity, and then paying yourself tax efficiently, which is where proper tax planning comes in, off an accountant like myself. And if you flip the coin from the negatives from a sole trader, you now have protection. You have only a certain amount of liability for you as an individual because the separate legal entity is now responsible for the creditors, not yourself personally. So your personal assets, your home, your car, the things that you value aren't available for creditors to pursue if something in business does go wrong, which, let's face it, sometimes it can do. You now have an extra layer of credibility, more trust from banks, business clients, suppliers, because you're set up on Companies House. They can search for your company, see that you're the listed director, they can see the registered office address, so they know they've got some form of physical location that they can tie to your business. So it gives them extra validation and credibility that you're an official business that they can engage with. Now you can also split shares. Because this is a separate entity, you can have what's called shareholdings that are split between different members. So you can go into business with partners, you can go into business with family members, you can go into business with your spouse, and you can split different shareholdings, again, giving you one, greater flexibility on the venture itself, but two, greater availability for tax planning, which is exactly what we want as your profits start to increase. And here's my favorite part about a limited company. It's the tax efficiency strategies that are available to us, the reliefs, the allowances, the timing of dividends, the paying yourself as a director and deducting that cost from your limited company profits because it's a separate entity. I could go on forever with this list. There's so much that we can do to make you more tax efficient. However, it does need to come at the right time, again, which we'll get into later in the video. And with that profit retention, you can then invest into assets, get a better return on your capital, set up more advanced structures like a group structure, which is something that entrepreneurs that are fast paced, they want to grow, they want to build wealth, is something that definitely sparks interest. So it opens up a clear path to building wealth, growing as an entrepreneur, and opening up an extra layer of being a business owner. Finally, because it's set up on Companies House and the shareholdings, you can now raise funds, you can give equity away, you can sell a business as a separate legal entity and actually get paid for the asset that you're now building. But with that does come some cons. You now have to submit annual accounts and a corporation tax return, as well as your personal tax return. You also need to do what's called a confirmation statement, confirming your director and shareholder details once a year. So there's now 4 submissions rather than 1 submission that you need to make as a business owner. So it adds complexity and it also raises the cost on your accountancy fees. But when we compare that to the savings that you get from the structure, if you're looking at this at the right time for you as the business owner, then it can outweigh. And although it was also included in the pros, it can be a con that you're now visible on Companies House. People can see you as the director, clearly listed, so it does remove some of that privacy that you did get as a sole trader. It also means that if you now want to extract some funds from your limited company, you've got to do it via a salary or a dividend. You can't just earn the money in your bank account and go and spend it. You've got to actually extract it in the right way and make sure that you tax plan accordingly so you pay the least amount of personal taxes possible. So it does add that extra complexity when extracting funds out of the corporate entity. So with pros and cons in mind, when should you actually switch? When do you make the change to limited company? Now this is personal preference. Some people want to start as a limited company straight away for that credibility and because they have huge goals of where they want to get to. They may want to take on shareholders, take on partners, but some that are just starting out in business and want to be as tax efficient as possible, they're looking for that magic number. At what level of profit or income do I actually make the switch to limited company? And the honest answer is there's no magic number. However, there's definitely a range that it starts to become sensible to start looking at a limited company. And that range is 50 to 70,000 in profits, not gross income. This is profits. Because at that point in time, you're starting to get into the higher rate band when you're a sole trader, which means you're paying 40% income tax on a high amount of your profits, which then starts to shift towards a limited company being more tax efficient. Because when a limited company has a profit, it then pays corporation tax between 19 and 25%, dependent on the level of profit that the company's got. However, when you then want to take that money out for personal lifestyle or personal costs, you then have to pay dividend tax, which is going to be 8.75% in the basic rate band after your director's salary. Meaning there's double taxation because you're paying at the company level, which is corporation tax via the limited company. Then you're extracting that income personally and paying dividend tax or income tax on a salary. So you start to then pay two forms of taxation, whereas on sole trader, you would only pay income tax and national insurance. So we need to weigh up what you need to take personally and what can be retained in the company, because that then determines your effective overall taxation in the limited company compared to sole trader, which then starts to determine, well, is it more tax efficient to be a limited company or do I remain sole trader? So now we're going to run a practical example. Let's say Joe, who is a videographer, he's earned £75,000 in profit after all his allowable expenses has been deducted from his overall earnings. What does Joe pay as a sole trader versus what does Joe pay as a limited company? So with a limited company, £75,000 in profits, we're then going to deduct a salary of £12,570 because you can pay yourself as a director from your own company, which reduces the amount of profits you're now going to pay corporation tax on. And with marginal relief included, you would now pay £12,793.95 in corporation tax. Now we're going to assume that you can draw out what you need for lifestyle costs up to the top of what's called the basic rate band, which is £50,270. So a further £37,700 in dividends you would extract personally, taking your total take home as personal income to £50,270. You would pay an additional £3,255 in dividend tax on that, meaning you've got net personal income of £47,015, retained profit in the company of £11,936, and total tax paid of £16,048.95, giving you an effective tax rate of 21.4%. For the sole trader, you can't deduct a salary cost, so £75,000 is going to be taxed straight away as personal income. That's going to be taxed in between the basic rate band at 20% and the higher rate band at 40%, giving you total income tax payable of £17,432. You're also going to pay Class 4 national insurance at 6% and 2%, one in the basic rate and one in the higher rate. Now that is going to total £2,756.60, meaning total tax paid is £20,188.60. So your net income, the 75 minus the tax paid, is £54,811.40, which is higher than the limited company. However, you don't have the retained profit, which is in the company available for distribution in later years, investing into different investments and assets, or putting back into the business to make more down the line, giving you an effective tax rate for the sole trader of 26.92%, meaning you pay an additional 5.52% in taxes on this worked example. So as you'll see from the worked example, at £75,000 in taxable profits, it's a clear decision that you would set up a limited company. However, my honest advice is, unless there's a reason for you to set up a limited company straight away, which is that extra credibility, the extra validation, the clear path to growth and the additional tax planning that you can put forward. Maybe you want additional shareholders. So unless you don't have any of them reasons, at £50,000 in taxable profits is when I'd start to compare a sole trader to limited company and see at that point in time, is it going to be more efficient for me to be a limited company? Am I going to keep more of my hard-earned money? So if you've watched this video today and you're considering making the move to a limited company, but you just need some additional certainty that it's going to be the right move for you, whether that's commercially or whether it's going to save you more in taxes, you can contact us and complete what's called a tax efficiency audit, where we'll break down the pros, the cons, and the detailed calculations that you need in order to make an informed decision on whether this is the right course for you. If this does sound like it's going to be helpful for you, the link is in the description box below. And as always, see you for the next video.